Capital Structure Analysis by Yamkela, Melissa, Andile, Mwedo, and myself, Mandilaki. Capital structure is a complex area of financial decision making. This is whereby a company chooses either to finance their assets through debt or equity. And we've been requested by Anglo American to do an analysis on their proposed capital structures and see which one would be best suited in the case of profit maximization. We have calculated the earnings per share, expected earnings per share, standard deviation, coefficient variation, and we have calculated how these have an impact on the debt ratios that we were given. Our findings will be represented in a graph, and my peers will spend a great amount of time explaining everything in detail. We hope that at the end of this presentation, we will be able to actually point out a clear picture on which capital structure will result to profit maximization and wealth maximization. I will now hand over to Andile to go further and discuss our findings.
Okay, so thank you, Mandy. So for a start, let's take a close look at our first graph. This graph shows the relationship between the debt ratio and the expected earnings per share. So as we can see, Anglo is experiencing increasing debt. That means they are substituting equity with debt. The expected earnings per share increases with financial leverage, so does risk as reflected by the difference in suspension, which is our standard deviations. This means that as our debt ratios increases, our standard deviations will also increase. Clearly, the uncertainty of expected earnings per share as well as the chance of experiencing negative earnings per share is greater when higher degrees of financial leverage are employed. As in this graph, it is not clear where the earnings per share will begin to decline. But we can assume that they will start to decline when it reaches the maximum, which is the debt at 56% with the expected earnings per share of 18.33. Looking at our second graph, which shows the representation of a relationship between coefficient variation versus the debt ratios. The nature of the risk-return trade-off associated with the three capital structures, which is the 50% capital structure, the 35% capital structure, and the 15% capital structure, under consideration can be clearly obtained by plotting the expected earnings per share against the debt ratios thereof. This curve, it represents two things. It represents the business risk and the financial risk. So this curve, it separates the financial risk, which can be identified as the area above the curve, and the business risk as the area below the curve. What we need to understand about these two graphs is that we have to notice that as the firm increases or introduces more of leverage or more of debt into its capital structure, it typically experiences increases in both expected earnings per share levels of return and the business risk. So this is the graphical representation between the relationships of coefficient variation versus the debt ratios and the debt ratios versus the expected earnings per share. Hence now, we will ask Yamgela to talk to us about the impact of increased financial leverage.
Let's take a look at the negative impact of financial leverage on financial risk. As seen, the business is more reliant on debt. And when taking on debt, there's a heightened increase in the level of risk involved. Financial leverage is the degree at which a company uses its fixed income securities, and such as your debt and your preferred equities. The more debt financing a business uses, the higher the financial leverage. Now, financial risk, on the other hand, is your risk to your stockholders, which is caused by an increase in your debt and your preferred equities. As a company increases its debt and its preferred equity, it also increases its interest payment and decreases its EPS. Taking, for example, the company using a debt ratio of 65% as opposed to the 10% one, it would obviously increase its interest payment and decrease your EPS. This all forms part of the increase in risk of shareholders' return. As a company makes its financial decisions, it needs to take in mind that optimal capital structures when making financial decisions, to ensure that as it increases its debt and its preferred equity, it also increases the value of the company. Measures of risk involve your standard deviation, which is the measure of volatility, as well as your coefficient of variation, which is the preferred method of assessment. I'll now hand over to Melissa to do the recommendations based on findings.
From the findings, we recommend that the preferred capital structure if the goal is to maximize EPS and share value as at 15%. The highest EPS is 28.43 at a debt ratio of 65%, and the highest share value at 177.69 at a debt ratio of 65%. EPS is equal to a profit. That means that's when a company is generating profit, and share value is equal to wealth. That means where the company is generating from wealth. I now hand over to Nedo with our advising.
Thank you, Melissa. With the given information, the Anglo Incorporation has a decision either to maximize on EPS or to maximize on share value. Under maximization of EPS, the company can maximize on EPS in order to make profits, which means that it is a short process. Under maximization of share value, the company can maximize in order to increase or to build upon their wealth, which would take a long period. As a group, we would advise Anglo Incorporation to maximize on share value, as it is a long process, and since Anglo is a mining company, it would need it.